Hello and welcome back to Intertax Learning. In the previous videos of Career Anatomy, we came across multiple international tax positions with the preferred qualification related to the Pillar 2 framework. I thought it would make sense to produce a video on the basics of Pillar 2 to provide a fundamental understanding of how it works. In global taxation, Pillar 2 is also referred to as the Global Anti-Base Erosion Rules. While the name implies an aim to combat base erosion, the mechanics are not at all similar to the US BEAT mentioned in the last video. Instead, the purpose of Pillar 2 is to establish a global minimum corporate tax rate of 15% for large multinational enterprises, or MNEs, as we call them. You will keep seeing this acronym, MNE, in the global taxation context. It basically refers to enterprises that have operations in multiple countries. Further, Pillar 2 aims to prevent these MNEs from shifting profits into low-tax jurisdictions. For Pillar 2 to apply, the threshold to meet is greater than or equal to 750 million euros for the entire group. If the MNE doesn't have enough revenue, Pillar 2 doesn't apply. Now, have you ever wondered why the framework is called Pillar 2 and whether there was ever a Pillar 1? Well, it turns out that there was a Pillar 1 and it is still active. Pillar 1 is focused on changing where companies pay taxes, and it covers companies with global revenue of more than 20 billion euros. As you can see, Pillar 1 applies to very, very large companies. It's no wonder some people have never heard of Pillar 1 because only about 2,000 companies in the world have revenues of over 20 billion. If you'd like to find out who they are, check out Forbes 2025 Global 2000 list. Back to our topic. Pillar 2, on the other hand, is very different from Pillar 1. It cares about how much tax is paid, and it covers companies with global revenue of at least 750 million euros, giving Pillar 2 a far broader application than Pillar 1. Pillar 1 and Pillar 2 in combination would increase the effective average tax rate by around 0.7% across all countries. Pillar 2 is responsible for the majority of that increase. Now that we know Pillar 2 is looking to raise each country's effective tax rate to 15%, let's look at the three collection mechanisms. I will be showing an example soon, so don't worry if you lose track. First off, we'll be mentioning top-up tax many times in this video. Just know that top-up tax is the difference between the company's regular income tax in a low-tax country and the 15% minimum tax. Let's begin. The first mechanism is called a local country tax. It is also commonly referred to as the Qualified Domestic Minimum Top-Up Tax, or QDMTT. It allows the local country to collect the top-up tax unless the local country doesn't comply with Pillar 2. The second mechanism is called a parent country tax. It is commonly referred to as the Income Inclusion Rule, or the IIR, which allows the multinational's parent country to collect the top-up tax unless the parent country doesn't comply with Pillar 2. The third mechanism is called the backstop tax. It is commonly referred to as the Undertax Profit Rules, or the UTPR, and it allows the other countries where the multinational operates to collect the top-up tax. So basically, the difference between these mechanisms is simply which country is collecting and from whom. I kept mentioning whether the country complies with Pillar 2. You might be thinking, collecting higher tax increases revenue, so why don't all countries comply? Whoever is not complying is basically losing revenue to other countries. That is true, but some countries use a lower tax rate as a strategy to attract capital inflow. For example, the US, the Cayman Islands, and the British Virgin Islands have not complied with Pillar 2. Although over 147 members of the OECD have agreed to Pillar 2, and over 65 of the 147 have formally enacted laws regarding it. If you like to keep track of the adoptions, this link I provided is the PwC country tracker. Now that we understand the mechanisms, let's see how they work in practice. The example I'm using here is from KPMG. In this example, the MNE is a group of 4 entities. The parent is in the US. It wholly owns a Netherlands holding company, which further owns a subsidiary in Switzerland and another subsidiary in Germany. Let's assume that the group's revenue is at least 750 million euros. That makes this MNE a qualified group for applying Pillar 2. Notice that the Swiss sub is the only entity with an effective tax rate lower than 15%, assuming the Swiss sub's global income is $100. Which country should get the top-up tax of $5? The default answer is that Switzerland should collect the $5 from the Swiss sub if Switzerland has implemented the local country tax, because Switzerland is the local country and it makes sense for it to collect the top-up tax. But what if Switzerland doesn't comply with Pillar 2? That brings us to our next scenario. If Switzerland doesn't apply, the parent country should collect from the parent entity. However, as I mentioned in the previous slide, the US has opted out of Pillar 2. We move down the chain to the intermediate parent entity, Dutch Holdco. The Netherlands would, in this case, collect the $5 through the parent country tax. The Netherlands also do not comply with Pillar 2. That brings us to our third scenario. If neither the local country nor the parent countries comply with Pillar 2, it is expected that the remaining countries where the group operates in will collect the backstop tax. In this case, Germany collects the $5 from the German sub. As you've come to realize, this backstop tax serves as the last resort for collection. But what if Germany doesn't comply with Pillar 2? In this case, the group doesn't have to pay a top-up tax. But in real life, that's almost impossible. If the MNE is large enough, it is almost certain that it would operate in at least one of the countries that adopted Pillar 2. Specifically, if the MNE structure is the same as our example, the Swiss sub would collect because Switzerland has already adopted Pillar 2. Alright, that's it for this video. Today we talked about Pillar 2's purpose and its mechanisms. There are other areas of Pillar 2 that I would like to present, such as the safe harbor rules, but that will be in another video. In the next video, I'll be talking about CAMT. I hope you stay tuned for the next one. Thanks for watching InterTax Learning, where we make international tax simple, one concept at a time.